Hi, everyone. Welcome to this episode of Beyond Max Q. I'm your host, Mollie Jahner. I'm joined today by Jeffrey Fidelman. He's CEO and founder, but he's done so many things, right? So you are in the M&A space. You're in the VC space. I just saw an amazing LinkedIn post where you got like hundreds of comments where you were, prognosticizing on VC funding and when that was going to drop. And so we are in for a treat today to kind of hear a little bit about all the things that are in your mind. And so with that, sir, if you wouldn't mind introducing yourself, I would appreciate it.
Yeah. Well, first of all, thank you so much for having me. I really loved our initial conversation, so I'm excited to have this one as well in the podcast. My name is Jeffrey Fidelman. My background, I guess in 60 seconds, who I am and what I do. My background, I'm a New York native. I grew up on Long Island, graduated Harvard. I spent a better part of a decade in banking. Half of that was at Morgan Stanley, the other half at HSBC. And then I went over to a venture fund under a family office. And the thesis there was early stage tech and tech-enabled investments, where we would anchor around and then help syndicate the rest of the capital to other investors. And in 2015, I left and started this investment bank, which is wild to say 10 years ago, that has since grown to just under 40 people, all remote, all US and Canadian based. And what we do today is help early stage companies as well as emerging managers with fundraising preparation. So helping them with decks, models, valuation, cap structure, things of that nature. And then also fundraising itself and execution. And we do that kind of in an atypical way we call fundraise as a service, or in other words, outsource investment relations, but happy to get into that later on.
Yeah, no, I think we'd love to dive right in. What is that? Fundraise as a service, right? Because there's so many accelerators and studios and, so how is it different than some of those things?
Yeah, so our focus really was on understanding understanding the fundraising space within early stage companies and within emerging managers, both of the markets that we serve. And when you're working at a larger investment bank or mid-market investment bank and your client is generating 20, 50, $100 million of revenue, there's a little bit of a different process where a lot of people would joke that the money's raised, we just have to figure out who is putting it in. With earlier stage companies, there's a lot more focus on building a relationship between the founder and the investor. And and oftentimes, both when I was in that role and we'll hear other investors say the same in different podcasts or stages and conferences, that they expect the company to be reaching out to them directly because that's who they want to build the relationship with. And and as we kind of dissected the market more and more, we understood that, well, it is kind of broken or doesn't exist, maybe is a better way to say it. It doesn't exist because the expectation from the investor is that the company reaches out to them directly. The few and far in between advisors that are in the space are either marketing engines that are throwing spaghetti at the wall to see what sticks, or on the other side, oftentimes, and not in all times, but oftentimes unlicensed advisors that are relying on their Rolodex or their phone book. And the problem with that is immediately upon engaging with one of those types of advisors, the dynamic of the relationship between the company and the advisor is counterintuitive to how the economics work. So what I mean by that is company A goes to advisor, advisor goes to John Smith, the investor. Company B to the advisor, John Smith, the investor. C, John Smith. D, John Smith. And what ends up happening is that despite the companies paying the economics to the advisor actually cares more about the relationship with the investor than he or she does with the company. I can go on and on about kind of the missteps about the industry and what we've seen before, but that's really why we came out and said, well, let's offer this as a service. Let's go and effectively productize best practices of raising capital. And that's what we did. So what does that mean? We're not attending events on behalf of our clients or anything in person. We still feel and advise them to do that themselves. But when it comes to building the outreach, doing the outreach, connecting with investors, that's really where we focus on. And the way we've done that kind of in simple, and a simple explanation is we've gone out, we've subscribed to a variety of different databases of investors. So PitchBook,
Mhm.
Preqin, Fintrix, Dakota, ZoomInfo are a number of those that are out.
Mhm.
I've been able to aggregate a lot of that data internally, enrich it further with all of the outreach we've done, and then we layer an analyst on top of that to do the outreach on behalf of our clients. So it's Alex calling from ABC Company or Alex emailing from abc.com, so
Mhm.
that from the investor's perspective, it's still a company that's reaching out to them directly. And we're not pitching anything other than the opportunity for that investor to connect with the founder. And that's in a nutshell kind of
Yeah.
how a one layer deeper on how we do what we do.
No, I love that. I mean, you've scaled being able to kind of almost commoditize relationships, right? Building those, because I mean, investors are investing in the founder and they want to know you. And so, how do you kind of at scale build that network quickly with almost like SDR like help, which I think is really interesting.
It is. It's funny that you say that, but that's almost how we hire as well. When we're recruiting for analysts, we're actually not looking for bankers. We're looking for SDRs and BDRs. Because ultimately, structurally speaking, that is what our analysts are doing. They're receiving these lists from like our internal analyst, going through the investor names, further qualifying them, personalizing them so that there's some sort of conviction when they reach out to the investor, and then they're doing the outreach. So it is very similar to an SDR or
Yeah.
marketing type of role.
Yeah, I mean that's my whole background is marketing and sales, so that immediately popped into my mind. I was like, "Oh, that makes sense." Like you're just kind of taking it, but it's a different function. And I will say it's probably a bit more nuanced. Again, because you're dealing with in most cases folks who are getting bombarded with asks for money every day. So it's quite a bit more nuanced in that sense. But I would also love to just see, okay, you're in this space, you're doing analyst work, you posted about it on LinkedIn. I would love for you to talk about, because everyone keeps saying, oh, it's a really tough time. It's a really tough time to fundraise. What's your answer to that? What are your thoughts on that?
I agree. I agree, and it's getting better. So there was an article published today, July, just so for dating wise, July 10th, by Crunchbase, where statistically they've seen a higher amount of capital flowing into the market, which I have been expecting for quite some time. And I might have been overly optimistic about last year, but the thesis remains the same. Something I posted about, something that I believe in, that when looking at macroeconomics over the past 7, 8 years, we've seen a cycle, still a cycle, but not really similar to what we've seen in the past, where there was a ton of capital coming into the market in 2018, 19, 2020, both into funds and into companies. And there was a lot of deployment going on as well. And then almost as much as there was, there wasn't. And a lot of these capitals have deployment windows. A lot of that capital is still sitting in cash, whether it's up at private equity waiting for IPO so that family offices could regain some liquidity, or the LPs, all the way down into the companies that had raised in the past. So I think we're coming into a market now, and what I've seen kind of on a microeconomic scale is that there started to be a lot more deployment into the fourth quarter of 2024. In the first quarter of this year, it was just dead quiet. I think between tariffs, geopolitical events, some other things in between there, and really as quiet as it was in the first quarter, maybe first quarter plus a month or two, I've seen it be that loud, maybe 1 or 2 weeks into June, and that continues now through July 4th week through today. I do think that there's going to be continued ramp up of investment activity throughout the summer, certainly throughout the course of this year. Um, Both for the reason that I do believe funds and investors must deploy that capital, but also the opportunity right now is immense, both in AI, which is everyone's flavor of the quarter of the year, but in a lot of other businesses that are using AI to augment their operations and revenues.
Right. Well, I love that, and I couldn't agree more with AI. It is certainly you're a unicorn. It feels like you wave a wand and now we're there. But I would love to get your perspective on, what type of tech you're seeing investors maybe open up the wallets a little bit more readily for.
Good question. I'll share my own perspective and opinion on that and
Please,
how I
yeah,
would think about it.
yeah.
And then a little bit more of what I'm seeing because it's not exactly the same. I've always been a big believer in investing in the infrastructure of new technologies. So take AI or take blockchain as an example. There is a output or a user company app, what have you, that you could invest in. Or there's the underlying infrastructure that things are built on, which you can invest in as long as you believe in the category. So an example of that, and I don't know if this is the best example, but some sort of agentic AI app from OpenAI to the one that just started yesterday, or a data center that needs to continue, or data center provider or data center developer, that as long as there are more and more AI companies, and even the ones that do exist will continue to grow, you must have this underlying infrastructure, which must continue to grow just to support the apps and companies being built in that industry. So I've always thought about the investment space in number one, the underlying infrastructure around new technologies, and also number two, in kind of unique applications of those growing technologies. So you have OpenAI, Perplexity, Anthropic. It's likely that they will continue to be the gold standard, barring any major black swan events. Um, but they won't necessarily go into specific use cases where other more nimbler companies can start either building off of those or building in addition to them. Where capital is flowing to, it seems to me that capital, aside from attracting more capital, is being invested really in high growth companies. So a lot of our clients, whether it's AI or not, the responses they're getting from investors with whom they're speaking is that the investors want to see forward progress. Um, and and what that means for an AI company, those metrics are slightly different because the benchmark is so high. So forward progress, even for a company that's raising a seed round in AI, seed investors are telling them to come back when they hit $500,000 or $1 million in ARR. And until then, keep us updated and in the loop, but don't expect us to take this to investment committee or write a check.
That's super interesting. I mean, I always am telling people that revenue is your best investor anyway. And I think there's like this kind of misnomer that like, all of a sudden you're building something and you have this idea, somebody should fund it. I think we've kind of gotten away from the idea of, we call it bootstrapping, but like just building a business, and it's not like this some thing that's, put on you, but it's like, hey, you're just building a business, because I think that product market fit, right? If you have that, then everything kind of falls into place. And so some of these companies, to your point, that are just kind of like, hey, I pick that, and then people fund it, that those days are starting to, I think, decrease, where we see that kind of activity, because like you said, there's more appetite for traction.
Yeah. And you know what? I would say two comments on that point. The first is take media with a grain of salt because they will report on a seed round that was raised for 20, $30 million within 2 months or 3 months. I say take it with a grain of salt because it's likely that one of the founders had just come out of Square or Meta or NASA or
OpenAI,
some
and now they have 2
open.
billion and they don't have a product.
Exactly. Oh, that's right. Exactly. So take that media with a grain of salt, and that those are outliers most often that they're reporting on. And the other piece around bootstrapping that you mentioned, and it triggered my mind, is that it's it's never been cheaper and easier, maybe is the right word, to build a company or to build an MVP of a tech product. And I'm sure that this can be recorded and then every day will be true
It's
going
crazy.
forward.
There's a new app. There's like Lovable and Replit and all these things. And
Yes,
it's like, I mean, boom, you have a UI. You don't even need to think about like, now I think there's security and there's like a lot of things that we still have to work through, like maybe a human in the loop type thing. But I mean, it's amazing how fast it changes. Like you said, day by day. It's like, what launched today?
exactly. And I'm I'm from speaking from experience in that we wanted to build a new CRM for our use internally. We didn't find anything that we could white label just from a use case perspective. So we went to a few development firms to understand price, time, all of that. And and kind of the best The best price from the most trusted kind of through advisors and introductions that we got was around $250,000 and around 9 months of time.
Hmm.
And we needed different integrations in there and a few other pieces. And you mentioned Lovable. I turned around and within about a month and $300 was able to build a relatively functioning MVP within Lovable. Functioning enough where I was able to take this, turn around to hire a group of developers and tell them literally build this for me, just make it work.
Yeah.
Connect it to the proper databases, get Google, Microsoft
Mhm.
authentication in there, do the things that I've hit my limit of doing. And to tell you that the price was one less than 1/10 and a fraction of the time as well is without exaggeration. So even getting to an MVP, it's no longer, tens of thousands or even thousands, it's a few $100. And yes, granted a lot of time that you would need to put in there.
Well, and that leads me to my next question. So I do a lot of work personally, through things that we're doing with, companies that are focused on hard tech, defense tech, dual use tech, right? They're really building something with their hands. And we've talked a lot about AI and software, and we've established that that's like, that's something that's going so quickly, and also to the point that it's like some things are becoming irrelevant like day by day, but that hard tech piece still seems steady state to a certain extent. And I would love to get your thoughts from an investment perspective and a fundraising perspective, like how you feel like that's going.
That's a great question. Um, there's been a lot less focus. We have had, so granted, all of my comments are coming just based on our experience with the existing clients that we have. And the majority of our clients today are some sort of software exposure clients, although we are working with a fund that invests in quantum technologies. And those technologies are often hard like hardware,
Like
sometimes
data
crossing
centers.
into deep tech. Yeah.
Yep.
That is a little bit of a harder pill to swallow for many investors because of the existing liquidity crunch that occurs now. When you think about deep tech or certain types of hardware technologies, the likelihood of not of revenue, but rather of a liquidity event and actual growth is is just longer. I don't want to say the likelihood is less or more. It just
Well,
takes.
in aerospace is like 7 to 10 years, right? So that's what my main experience is with, is like, aerospace exits and things like that. So it's like, okay, 7 to 10 years out, which most investors are like,
Right. Well, with
roughly
space
about that
technologies
time.
as well, and we're working with somebody in optical free space and RF antenna technologies, specifically for like ground to space communications, like Starlink, think Starlink types of things. And the reality is just from ideation through like fab and development and getting to a product that you can test that works takes a few years. And that process is extremely expensive. So unless you're getting some sort of government funding or grants, you need to go out to private investment to do that. And I do think that remains to be extremely difficult. I think the government has been very helpful in that sense, where they are providing a lot of companies with the funding in order to develop certain technologies for certain uses, and also being open to providing those same companies that develop them with commercial rights to use those technologies and actually sell them. At that point, though, is really when a lot of these companies need to flip the switch and go from, hey, we have a bunch of government contracts that we're booking as revenue, to, okay, now we need to go and sell it to the private sector. And to do that, we need to get some dollars to build out kind of the company further. Um, when it comes to those, what I'm seeing is getting as close to revenue as possible. And it is possible. Again, hypothetical situations are harder to discuss, but if you get your product to a point of JV partnership licensing, go to a Lockheed or Raytheon, a Telesat, a Viasat to say, hey, yes, we'd be interested in implementing this. We'd run a test with you, or we will run a test with you. That would probably be the furthest you should and can get before turning around and going to investors and saying, hey, we need your capital in order to actually effectuate this. Development capital is much harder, just because it has so much more of a binary outcome.
Yeah, no, that's well said. I appreciate that. And we always keep these short. So I feel like we've covered the funding piece. I want to get your perspective on being a founder because you are CEO and founder. And I would love to like have you kind of flip the script now. Okay, we're talking about like now you're in the founder shoes. What has your experience been like? And, as a founder and as you've grown to 40 people, because that's actually quite the scale up, I think, of a business. So talk a little bit about that.
Well, 10-year overnight success, right? Um, so it's true what they say. You have to be a certain type of, I don't know, crazy is the right word or not the right word to use, but uh, a certain type of that in order to take that path. It is not without its difficulties, and everyone can always talk about the grass being greener on the other side. Um, I think it takes a lot of conviction. I think it takes a lot of trial and error. I think that as a founder, it's more important than in any other position to look at failure differently, and really learn from mistakes and try to adjust or be agile at least and adjust and continue implementing. Probably one of the most difficult aspects of being a founder is failing the right way. And what I mean by failing the right way is just because something doesn't work for a week or for a day or for even a month doesn't mean it doesn't work. And I find that what does not work most often is changing too much too fast. And what I have seen that does work is taking data, at least from my mind, and maybe this is maybe because I have a financial background too, but being able to implement something for 60, for 90, for 120 days, and then taking the data out of that to adjust. My philosophy that I've taken, whether it was from day one or more recently, is kind of like a scientific method where you have a hypothesis, you have a test which has a variable and a control. You run that test, you analyze the data, you have a conclusion, and then you do it all over again. And it's really important to, whether it's that or any type of process, to have a process around the business that you're running and that you're growing. Having the data come back from trying anything you do, and then being able to analyze that to say, hey, did this work? If it did, great. If it didn't, let's figure out what didn't work about it and then try it again. I've heard a lot of founders, a lot of CEOs say something along those same lines. I may or may not have taken that to heart day one, but now I definitely do.
I love that. I love that perspective too on failure and trying something for a little bit longer and not being so discouraged. But it is when you're in that crunch to produce revenue, it can feel hard, right? Like, okay, if it's scaling from 0 to 1, like now I have people that are relying on me as the CEO and founder to pay them, right? That's like like a deep breath, like that weight. And does that ever go away?
Not yet, not yet.
Okay, it's good to know.
We'll do another one of these in a little while, and I'll let
Okay.
you know. But I think to that effect, making decisions out of emotion is not a good idea either. And if you are feeling really stressed or really anxious or really happy for that matter as well,
Yep.
any reaction that you have in a professional setting that is made out of emotion, um, I don't want to say it's wrong. That's not what I'm trying to say, but I think it's always good to take a step back, analyze kind of what will this response or my reaction, what type of impact will that have, or how should I position something, and then coming back and doing it. So same thing, having a business with that amount of people, with the market being what it has been over the past 3 or 6 months, has not been without its trials and tribulations. Um, but you really, really have a chance in those times as a CEO or as a founder or as even the person who is responsible for team culture to have consistency and to have positivity, cautious optimism, other people might say, and leading the company, because positivity will, beget positivity, and likewise, negativity will just breed more negativity.
Well, and I actually was just posting about this the other day. I call them like take a walk decisions. Like even if you're super happy, you're super excited, or you're really down in the dumps, or like go take a walk. And then chances are when you come back from that walk, you're going to have evened out and you're going to have thought about it. And you might not be making the same response or decision or you would have if you'd done it in the moment, to your point of removing emotion. So I feel like that's one of those things that I like to think about. But as we close, is there anything that you'd like to tell our audience, which is primarily made up of founders, but we also have some funders here, just, anything you'd like to impart as we start to wrap up?
Um, yeah, funders first, then founders. To the funders, in my opinion, having sat on now all three sides, I suppose, please get back to people and give them some guidance on why you're not doing it. Like if
No
it's not
ghosting.
personalized, yeah, if it's not personalized and they're just sending you like a random canned email or a templated email, fine, I get it. No need to respond. It's on them. But if a founder has made an effort to a funder to reach out and really personalize and there's somewhat of a fit or there's somewhat of an effort, it would be appreciated. Certainly, I'm speaking from the founder's perspective to understand why. Even from our perspective, when we're trying to run an analysis on why didn't this person react or respond or want to invest, so that we can better target investors for that client. So I'm sure a lot of founders will share that sentiment. And to the founders, AI use AI as a tool as opposed to as a replacement. Unless you're building an AI agent or an AI company, really what I have found, at least so far, that has helped us grow, has helped us deliver better value and services to clients, it's been using AI to kind of augment what we're doing and implementation, whether it's building an MVP, building a product, getting ideation and kind of implementation and collecting data on that. It's really been powerful as a tool or as a sidekick to enhance not necessarily even the growth of the business, but enhance the investability of a business, because you start tying up a lot of those loose ends that maybe you wouldn't have otherwise thought about. And if you have an idea, like I said, there's platforms like Lovable, there's platforms like Replit, there's other platforms out there that for a few $100s and a few hundred maybe hours of time, it's possible. It's at least able to get you to more than just a clickable PowerPoint to get in front of people. And the amount of knowledge you will gain from trying to build your own product, even without a engineering or development background, is absolutely priceless. Exactly. What am I currently reading? Thinking Fast and Thinking Slow. I haven't actually read that one yet, and I'm kind of just a big fan of the collection. So I'm starting to read that. I'm maybe a chapter or two in, that I'm getting to in the evenings. But Thinking Fast and Thinking Slow, and it's had a different meaning. I think I read it in high school many years ago, and reading it again now after having gone through kind of professional life and business gives me a different appreciation for decision making. Likewise, thank you so much, Molly, for having me.